The 60-40 portfolio is dead. Here's what works now. The 60-40 portfolio, once the gold standard of investing, just had its worst year in history. That classic mix of 60% stocks and 40% bonds, long considered a safe and steady strategy, lost 16% in 2022. Why? For the first time in decades, stocks and bonds fell together. The negative correlation that made this strategy so reliable has flipped. Vanguard's research shows the stock-bond correlation recently hit plus 0.60, a dramatic shift that changes how we need to invest. For 2 decades, bonds cushioned portfolios when stocks dropped, delivering smooth 7% annual returns with minimal volatility. But in 2022, both assets crashed. Stocks fell 19% and bonds dropped 13%. Diversification failed when it was needed most. This isn't a one-off event. It's the new market reality. So what's the solution? Vanguard's analysts suggest a new approach. The 50/30/20 portfolio. That's 50% stocks, 30% bonds, and 20% alternatives. This mix could deliver similar returns to the old 60-40 strategy, but with less risk. Alternatives like commodities, real estate, and managed futures don't move in sync with stocks or bonds, providing true diversification. Backtesting shows this updated portfolio would have lost just 10% in 2022 instead of 16%. Here's how the alternatives break down. Commodities. In 2022, while stocks and bonds were crashing, commodities gained 16%. Oil, gold, and agricultural products respond to different economic forces, making them a stabilizing force. A 5 to 10% allocation to commodities can help smooth out returns. Real estate investment trusts, REITs. REITs offer 4% yields and inflation protection through rising property values and rents. While they're still stocks, they often move differently than the broader market. However, they're not a perfect hedge, as 2022 showed. Managed futures. These funds use algorithmic trading to go long or short across commodities, currencies, and bonds. The SGCTA index, which tracks these strategies, gained 18% in 2022. They thrive in volatile markets, but come with high fees and complexity. Gold. While gold didn't shine in 2022, it has historically preserved wealth during crises. Physical gold ETFs like GLD offer easy exposure, though gold's returns can be unpredictable. Infrastructure. Investments in roads, utilities, and pipelines generate steady cash flows with inflation-adjusted contracts. ETFs like IGF provide diversified exposure to this sector, which has outperformed global stocks over the past 20 years. Treasury inflation-protected securities, TIPS. Though TIPS struggled in 2022, they adjust for inflation over time. Short-duration TIPS ETFs like STIP limit interest rate risk while offering inflation protection. The key is balance. Vanguard recommends capping any single alternative at 5% of your portfolio and spreading the 20% allocation across 4 to 5 different options. Rebalancing annually ensures your portfolio stays on track. Fees and liquidity also matter. Many alternatives charge high fees, which can erode returns. Stick to low-cost ETFs whenever possible. Publicly traded alternatives offer more flexibility than private equity or hedge funds, which often lock up your money for years. The bottom line? The 60-40 portfolio isn't dead, but it needs a serious update. The 50/30/20 approach, with its focus on alternatives, global diversification, and disciplined rebalancing, offers a more resilient strategy for today's markets. Adapt to the new reality, and your portfolio will be better prepared for the future. The short-term Treasury opportunity. Right now, 3-month Treasury bills are paying 5.5% with virtually no risk. Never before have short-term Treasuries looked so attractive, offering the highest yield on cash equivalents since 2007. The inverted yield curve makes this possible. You're getting paid more to take less risk than with longer-term bonds. It's a rare opportunity, but you need to understand both the benefits and the risks before diving in. Think of it like finding cash in your couch cushions. Unexpected, but you'll want to use it wisely. A $100,000 investment in 3-month bills generates $5,500 in annual interest with minimal risk of losing principal. Compare that to a 10-year Treasury note yielding 4.5%, which comes with much higher price volatility. The shorter duration also means you can reinvest at higher rates if they continue rising. However, This strategy can backfire if rates fall faster than expected. JP Morgan's fixed income team highlights this exact risk. While short-term treasuries are appealing now, reinvesting at lower rates becomes a problem if the Fed cuts aggressively. Their advice: build a ladder of maturities instead of going all in on the shortest bills. This means buying bills that mature in 1, 3, 6, and 12 months, spreading out reinvestment risk and maintaining flexibility. The current yield curve supports this approach. 1-month bills yield 5.4%, while 1-year bills pay 5.2%. That's a smaller drop compared to the 1.5% gap between 3-month and 10-year yields. By laddering maturities, you capture most of the short-term yield advantage while hedging against rate changes. If rates rise, you can roll into higher-yielding bills. If they fall, you've locked in some higher rates for longer. Money market funds offer another way to access these yields without buying individual bills. Funds like Vanguard Treasury Money Market, the USXX, currently yield 5.3% after expenses. They provide daily liquidity and automatic reinvestment, making them ideal for parking cash. The trade-off? Yields adjust immediately when rates change, unlike individual bills that lock in rates until maturity. The Fed's policy outlook adds uncertainty. Markets currently expect 2 rate cuts this year, but inflation data could shift that. If inflation remains stubborn, short-term yields might stay high longer. On the other hand, a weakening economy could prompt faster rate cuts, causing yields to drop. Laddering helps hedge both scenarios by ensuring you always have some cash maturing to reinvest. Corporate treasurers are already ahead of the curve. JP Morgan reports that 78% of corporate cash now sits in maturities under 1 year, up from 55% in 2021. Retail investors can take a cue from this strategy, especially given the tax advantages. Treasury bills are exempt from state and local taxes, making them particularly attractive in high-tax states. For someone in California's top bracket, a 5.5% Treasury yield is equivalent to about 6.5% taxable. The opportunity cost of waiting is significant. Keeping cash in a near-zero yielding account costs you roughly 0.45% per month on $100,000, adding up to $5,400 annually. Even allocating half your cash to short-term treasuries can make a meaningful difference. Liquidity isn't a concern. Treasury bills trade in the world's most liquid market, with minimal price impact and bid-ask spreads as low as 0.01%. This makes them ideal for emergency funds or short-term savings goals. Inflation remains the biggest risk. While 5.5% beats current inflation, real returns could turn negative if price growth accelerates. A mix of short-term treasuries and inflation-protected securities, TIPS, can provide both yield and inflation protection. To simplify management, many brokerages offer auto-roll features for treasury bills, automatically reinvesting maturing bills. This hands-off approach ensures you maintain your ladder, though you'll lock in whatever the current yield is at each roll date. For most investors, 6-month bills may hit the sweet spot. They yield about 5.4%, just 0.1% less than 3-month bills, while offering more time before reinvestment risk kicks in. Splitting your allocation between 3-month and 6-month bills balances yield with flexibility. When to buy the dip? The bond market is still in the early stages of a bear market that could last several more years. History shows these downturns typically run 3 to 5 years, and we're only about 2 years into the current one. The last major bond bear market ran from 1967 to 1981, a brutal 14-year stretch where investors who bought too early got crushed repeatedly. This time likely won't be as severe, but the lesson remains. Timing matters just as much as selection when buying bonds. Have you ever jumped into an investment too soon, only to watch it sink further? That's the risk bond investors face today. Morgan Stanley's fixed income team has studied every bond bear market since 1950, and their research shows yields usually peak 12 to 18 months before the Fed starts cutting rates. With markets currently pricing in rate cuts beginning in late 2024 or early 2025, yields could top out between now and mid-2025. But in the 1970s, investors who bought bonds too early saw their holdings lose another 20 to 30% as inflation raged on. The takeaway: patience pays off when inflation isn't fully under control. So, how do you know when it's time to act? Let's break it down into a checklist of key indicators. Core PCE inflation. This needs to show sustained movement toward the Fed's 2% target. The latest reading of 2.8% is still too high. Job openings. These have fallen from 12 million to 8.8 million, but need to drop further to ease wage pressures. The Fed's balance sheet. The Fed is still shrinking it by $60 billion monthly, which adds pressure on the bond market. Each of these signals will help confirm when inflation is truly beaten and the bond market is safer to enter. Credit spreads are another critical signal. High-yield bond spreads typically widen to 5 to 6 percentage points over Treasuries during peak stress. Right now they're at 3.5 percentage points, so we're not there yet. Similarly, investment-grade spreads above 1.5 percentage points often indicate serious economic risks. Currently, they're at 1.2 percentage points. Keep an eye on these levels, as they can signal when the market is pricing in maximum risk. The yield curve also plays a role. The current inversion between 2-year and 10-year Treasuries needs to start normalizing. Historically, the curve begins to steepen about 6 months before recessions as short-term rates fall faster than long-term ones. Right now, it remains deeply inverted, suggesting more pain ahead for bond investors. Wait for clear signs of the inversion easing before making big duration bets. Other economic indicators provide additional clues. Corporate earnings revisions, for example, are still trending downward. S&P 500 earnings growth estimates for 2024 have dropped from 10% to just 3%, signaling more economic weakness ahead. When these estimates stabilize, it could mean the worst is priced in. Housing data is another early signal. Existing home sales have stabilized at low levels, but prices haven't fallen much yet. A broader decline in housing prices would indicate the Fed's rate hikes are fully working through the economy. Right now, prices are only down about 5% from their peaks. Finally, watch commodity prices and the dollar. The Bloomberg Commodity Index remains 25% above its 2019 average, and the dollar index is near 20-year highs. Sustained weakness in both would signal easing inflationary pressures. Similarly, bank lending standards and money supply growth are worth monitoring. When banks stop tightening and M2 money supply turns positive again, it could indicate the Fed is done fighting inflation. By following this checklist, you'll be better equipped to time your bond investments and avoid the costly mistake of moving too soon. The bond market's warning lights are flashing red, signaling risks that have preceded every major financial crisis. But here's the opportunity. Investors who act now can position themselves to profit. Next week, we'll reveal the 3 bond ETFs experts are using to safeguard their portfolios, one of which gained 18% during the 2008 crash. Preparing now isn't just smart, it's empowering. The secrets to survival lie in these 3 ETFs, and they could change everything. Hit subscribe and turn on notifications to stay ahead.